Hi, I'm David Humphreys, and this is a video tutorial about how to use my workbook, A Perfect Storm Portfolio Analyzer. Now, what is a perfect storm as far as buy-to-let and property investment is concerned? This analyzer covers increasing interest rates, reducing rents, falling property prices, negative equity, and a capital gains liability on sale, all coming together at the same time. And this workbook is set up to demonstrate that these 5 circumstances can arise at the same time in a single property. And the analyzer has been built so that you can analyze each individual property in your portfolio to see whether or not you are facing a perfect storm with each property. Not all properties, just each property. This is the trial version, and you're able to enter 3 properties in this trial version, which is, as I say, it is free, and there is a 50 property version, which again is fully unrestricted, which unfortunately you have to buy from www.buytolet.com. If you need any help or assistance having downloaded this trial version, please email me. Okay, so let's look at the variables. Starting off with the reference number if you want to use it. We then need to know what your tax rate is. I've set it at 40%, but it may be lower. And then the next is the CGT rate, capital gains tax rate, which maxes at 28% currently. Everybody's entitled to an exemption before they start paying capital gains tax, and the CGT exemption per person is currently £10,600. Then we look at the retail price index, the rate of inflation, and the latest rate we had was 3.5%. We're now talking about May 2015. All the green cells, by the way, are variables that you can enter. The white cells here are all autocalcs. We then need to know the number of properties that you have in the portfolio. Obviously, for the purposes of this trial version, you would enter a maximum of 3. We then set an LTV rate, which results in any LTVs being higher than this, the cell turns red as a warning. We then come to the tax paid monthly income, which is an autocalc, and I'll show you where this comes from later. And then the committed monthly personal spend, and this is quite important. Assuming that you were receiving £80 a month tax paid monthly income, the probability is that you will have committed to spending some of that money on personal affairs, personal costs. It may be the gas bill, through to a holiday, through to school fees. It's your choice. But out of this £80, you are committed to spending, in this example, £50. And then we come to the interest rates will start to rise when. It's your decision. I've set it at 36 months, and for the purposes of this video, that is May 2015. If you download this portfolio analyzer after May 2015, then this date will change automatically. I just want to go back to this committed monthly personal spend. The reason for having the number of properties in the portfolio is that the committed monthly personal spend is split between each property. So in this case, one property, the whole of the monthly spend will go on a single property. But if you enter 2 properties, then on the analysis that I will show you later, there will be £25 for each property that you own or is in the portfolio. But we will return to this point when we look at the analysis. Now, to take a look across the headings, And I'm not going to dive into the headings because they've all got comment boxes, as you can see. And I don't like them flashing up on the videos. The first column is the number of the property, and this column is a hyperlink to the next page, the property analysis page. If I hover over a number, you can see that there's a hyperlink, so if I click on this, it will take me to the next page. And I will do that when I've completed showing you this page. We then come to the property address, postcode, and whether the property is freehold or leasehold. F for freehold, L for leasehold. The type of property, semi, detached, terraced, and the number of bedrooms. Then the price you paid for the property, and the amount you spent on buying it, that is legal fees, etc., and refitting it before the first let. Your value today, what you think the property is worth, and then I want a for sale or sold comp off Rightmove. If it's a for sale comp, you leave it as black. If it's a sold comp, then you colour it red. You change the typeface to a red typeface to show you which you're using, either for sale or sold. And then we come to the likely actual sold net cash. If you sold the property for, say, £65,000, you would not bank £65,000 because you have some legal costs. At the same time, if you advertise the property for sale at £65,000, the probability is that you would accept a lower figure, maybe £60,000, off which would be taken the legal costs and agency fees. Anyway, by setting this percentage here, reduce the comp by, in this case, 10%, out of this £65,000, you're expecting to bank £58,000 or £58,500 after all costs. Now, if the property is slightly run down or tired, it's possible that you could spend, say, £2,000 in this example and increase the value. So in this example, by spending £2,000 on the property, we're going to increase the value from £65,000 to £70,000. Then we come to the gain, and the gain rate or the growth rate is individual to each property and location, and you can enter a minus figure. If you enter 0 or a figure less than 0, then in the analysis it turns red. Next question is, do you let furnished or unfurnished? And then we come to the rents. The current rent in this example is £450 per month. But that rent may increase, may be the same rather, may increase or may decrease. If it's the same, you enter £450. If you expect the rent to remain the same until May 2015 in this example. If on the other hand you're expecting to do an option rent as an example, you may increase the rent. On the other hand, if it is a local housing allowance rent, LHA rent, you may have to decrease it. And this example has an LHA rent reducing from £450 to £425 per month. We then come to the number of void days in a year, and I've set it quite tight at 7 days, which means that each month the £425 rent, because this is the rent that will be used for calculations later, will be reduced by £8.15 in this example. Okay, well that brings us to the end of the first part of the first page, and now I'm going to scroll across to pick up the second part. And here we are, and the second part deals with the loans. The loan amounts and expiry dates, redemption fees and expiry dates, and the total of loans and the average LTV. So here we have the first loan, and we have the total of the loan, the type of loan, and this is quite important as you will see later in the analysis, whether it's a variable loan, let's say, or a fixed loan or a tracker loan, and the expiry date of the loan. If the loan carries early redemption fees, the amount of those fees, and the early redemption fee date, very important. Then we come to the second loan and also the third loan. And if you look at the types, this is set up as a variable loan, The second loan is set up as a tracker, and the third loan is set up as a fixed loan. The total of all loans, excluding the redemption fees, is £57,000, and this is an auto-calc, and here we have the loan to value at 97%, which has turned red because it's above that figure we set at the beginning of 85%. And then we come to the monthly payments and costs, and I'll scroll across and pick those up. And here we have the monthly payments and interest rates. Now, the sum you enter into this first loan monthly interest payment is the interest only. If you have a repayment mortgage, you must split the interest out and put the interest only in. It auto-calcs the interest rate. We then have the second loan monthly payment, in this case £12, and it auto-calcs the interest rate, and the third loan. So the total interest payments in this example are £229, an average interest rate across all three loans of 4.82%. We then come to the monthly costs and charges, and we have the leasehold costs if the property is leasehold, and this will include the ground rent, maintenance, repair, and any management charges. Then we have the insurance, property insurance, and statutory check, and this is the monthly figure. And just a small point, often the insurance, if you pay monthly, you pay the entire premium over a 10-month period and not a 12-month period. So it's important to get these numbers correct. Likewise, you'll have to divide the cost of any statutory checks by 12. Then we come to repairs and maintenance, and finally letting and management, which I've set at 12%, including VAT, which effectively is a 10% rate plus the VAT, currently 20%. Now, even if you go the DIY route on letting and management, you should still put a percentage in this slot, in this cell. 2, 3, maybe 4% on the DIY side, because you're still going to have letting and management costs even if you're doing it yourself. And in this example, it gives us a £133 pre-tax monthly cash flow. And note, I'm calling it monthly cash flow rather than income. I'm now going to go back to the first page to show you what happens to this £133. And here we are back on the first page, or the beginning of this page. And the £133 income has been reduced to £80 tax paid, remember, tax paid monthly income, after taking into account your tax rate of 40%. We're now going to go to the second page, the property analysis. And here I click on my hyperlink and open up the property analysis for the first property. And here we are. A perfect storm, individual property analysis. And here is a note. If any figures in any property analysis turn red, then you have a problem. Right, to look at what's in this analysis. The first line is all brought forward from the previous page. So we have the number of the property, the address of the property, and to return to the previous page, by the way, you simply click on this hyperlink, which will take you back to the first property. And this is very important because on this page there can be up to 50 properties listed and filled up, and there's something like 2,000 lines on this long page. So you need to be able to go to exactly the property that you want to look at. We then have the postcode, the total cost. I'm going to go above it, the total cost, and this is the purchase price plus the cost of buying and refurbing. The current value, the gain rate or growth rate, and this will turn red if you go to 0 or less than 0, if property prices are falling in the location. The total loans on the property, the current rent and that reduced rent. Remember, we went from 450 currently to 425 because of LHA. Whether the property is furnished or not, the value of the voids that you're going to take off the rent, the operating costs, which are now insurance, statutory checks, maintenance and repair, and the letting and management percentage. That brings me to the end of part 1 of this 2-part video tutorial. I hope you found it interesting, and I look forward to seeing you in part 2. Thank you.